Hello, this is Professor Catherine Close, and today we're going to have a discussion about one of the subsidiary ledgers that we use in accounting. In fact, this week we're talking about accounts payable, accounts receivable, and the general ledger. And these are often subsidiary ledgers. The first two are subsidiary ledgers that many of us start in when we start our careers in accounting. And we're going to look at it through the lens of accounting information systems. We've been doing work on databases, how we design them, how we use them, how we analyze data from them. These are two, accounts payable and accounts receivable, are two really important areas for database structuring, because what we're doing is we're actually having a subsidiary ledgers, for example, for vendors that roll up into the general ledger account called accounts payable. So understanding the table structure and the relationship, understanding what kind of things could go wrong in terms of internal control are all very important. So that's what we're going to focus on today as we are talking AIS and analytics. So you know that these idea boards are intended to just pull out what I think are the most important concepts in terms of the chapters. So let's start there. So when we look at accounts payable, it's a part of the purchasing and payments process. And it really is about where we as an organization or a company get our supplies or our inventory, and we are typically buying them on credit, because remember, accounts payable and accounts receivable are generally called trade accounts, and it's important for us to establish these credit relationships, right? And in this case, for accounts payable, we are promising our vendor, they are invoicing us, extending credit to us, and we are promising our vendor that we will pay in a specific amount of time. So how does purchasing happen in an organization? That's what we're interested in here on the slides on the left-hand side, inventory and other purchases, right? Remember, these are our diagrams that we've learned about, right? Are how we document processes with visualizations. So I remember being in an accounting class at Montgomery College in 1994 as I completed some courses to sit for the CPA. And as I had already worked in accounting, so I had a good idea about how processes worked in an organization. But another student didn't have that experience. And they asked, well, how does accounts payable know that they should pay that invoice? And that is a very good question, because what happens, that's part of the purchasing process, which then flows into accounts payable. So first of all, when a company is going to go out and buy something, they prepare what is called a actual purchase requisition. A requisition is just asking permission, right? So somebody in the organization is going to go to a supervisor, prepare and present a purchase requisition, and then the supervisor is going to approve. So we have this documentation of approvals, these series of approvals, and then they'll go through and if they decide that a purchase is necessary, someone will prepare the purchase order, present it to the purchasing department. That department will place the order and they will send it to the vendor. We've already maybe have a standing account with a vendor, which is very important. So we have a credit relationship with the vendor, and then we wait for our goods to come. And when the goods come, they come into receiving, and we are going to compare the purchase order to the actual shipment that came in. And if everything's acceptable, we'll accept it. If there's some kind of anomaly or discrepancy, we'll report it. We may reject the entire shipment if something is like really off base with the shipment, but otherwise we're going to accept the order. And at that point, we're going to put the goods where they need to be stored and be available to the organization. And then the purchase order with the invoice. Now, the invoice may come with the shipment, but certainly then if that happens, we're going to send the invoice and the purchase order and the receiving slip over to accounts payable. If we just receive it, we will send the receiving slip with the reference of the purchase order over to accounts payable, which should already have a purchase order on file, and they'll wait for the invoice and match the invoice to the purchase order, which gives permission to pay, right? And we also have the documentation of the packing slip or shipping document, and at that point, we can set up the process of paying the invoice in the accounts payable module. Now, the thing to remember about accounts payable, accounts receivable, payroll, there are records, data under each of these master accounts. So for accounts payable, each vendor that we deal with, each supplier has their own little ledger, has their own little record, right? And we're keeping track of bills that come in or invoices that come in and when we paid them. And our permission to pay also has to do with this backup documentation. The same thing with accounts receivable. Under accounts receivable sits all the accounts of customers to whom we've extended credit. In payroll sits all the accounts of employees who we are paying. Okay, so once the invoice is paid, there's going to be all these inventory control processes for what we purchased or supply control, things of that nature. We might have to update some other subsidiary ledgers, right? But the account, the balance itself in accounts payable will roll up into the general ledger. We know the general ledger is the official documentation of what's in the accounting system at that point. Okay, so this is a very important process to understand, and it can be there can be fraud in it, and that is why having this authorization, this chain of approvals and acknowledgments and checks is so important. So how do we control the process, right? So we want to really look at what are we dealing with? What processes do we have to control? And what are the risks associated with this process? And who owns this risk, right? And in this case, because who owns the risk is the party responsible for helping us resolve, prevent, and resolve instances around risk or fraud. So we have associated with this process vendors, we have orders that are placed, right? And we have orders that are received. So there's control activities. So we want to be able to understand what do we have to look out for, right? What do we have to look out for when we're doing this? So in terms of vendors, right? These are all the external parties that we get supplies or inventory from. We've established credit with them. You got to kind of look at both sides of this, right? I always say accounts receivable and accounts payable are mirror images of each other. So a company is extending credit to our organization, and we are making a promise to pay. One, we want to make sure that the proper people in the organization are signing these credit agreements, right? And opening these credit accounts. That's a very important thing, right? And then we have a lot of times there's automated portals and there's documents and there's different steps in the process, and most important, there's training. So who would take care of these things? So who is responsible for these different functions, right? So what's interesting about vendor management, that has come a long way, right? Now we have the ability not only to look at the vendor's website and place orders on their site, right? And things of that nature, but we also have the ability under what we call uh, vendor managed inventory for them to look into our accounting systems, take counts, and automatically place orders for us and things of that nature. So we have come a long way in terms of that, but underneath there has to still be this signed agreement, this approved agreement. There also has to be often certain types of documentation related to the vendor. We have to provide them with information, they have to provide us. So there has to be a system for that. So we need automated system control in that process. We're going to have a lot of processes like we just reviewed in this. They should be documented, right? And they should be well known right from the AP department up to higher level management and across all levels of operations. So people know how to go through a procurement process and know how to get the proper authorizations. And all of this first begins in the purchasing department, ends up for payment in the accounts payable, and then once those supplies or inventory are in operations, various other are involved. So we should have a director or VP of operations. Within purchasing, we should have a purchasing manager. So this person is also responsible for helping establish segregation of duties. We don't want somebody, as we've talked about that in other classes, you don't want one person doing everything. We don't want the same person to be initiating the requisition, approving the requisition, creating the purchase order, placing the order, receiving the order, duties across several different individuals who aren't performing the same function that can give the opportunity for fraud or dishonesty. Training is a very important thing. Documentation is a very important thing. So we'll be placing the order, and here we go through what we described earlier, right? The different steps in the purchasing process. You're going to have automated steps, and then you're going to have people approving things like the CFO, um, approving these orders, or a series of documents that ensures that many different eyes have been on this. We then place the actual order. So we had a requisition, and then we have placement. Again, another individual, director of operations, who may be over the purchasing manager, who is supervising purchasing agents. And then we have receiving, right? So receiving is coming back onto the company's location, counting, documenting that the order is placed, documenting that the order was approved and that there was authorization to receive it. And then the director of operations is often over that. So control and receipt of goods to avoid timing problems, right? Um, we also want to record anything that's wrong with the inventory. All of this ends up going over to accounts payable. And through the documentation in that process, they will know whether they're authorized to pay or not. So we've taught, that, so that scenario talks about regular ongoing purchasing that is really part of, supplies for an organization, inventory for an organization. We often carve out fixed asset purchasing because these are usually large ticket items, right? So, and fixed assets are often recorded in a different record or ledger for the purposes of their initial historical cost, their depreciation to date, right? Their useful life, and basically their book value. If you remember when we talk about kind of what we're tracking around fixed assets. So when we acquire fixed assets, right, we're going to go through the procurement process. We're going to get the purchase requisition. We're going to get the approvals, right? But then we're also going to be worried about their management once they're received into the organization. So we need to receive and tag the fixed assets. So inventory we know is often tagged by, nowadays it's tagged by barcoding and with something called SKUs, stock keeping units. When we tag fixed assets, they also often also have a tag that assigns them a number, right? Assigns them to a department. So we have a whole management system there that allows us to track where any of these items are at any given time, right? We record the acquisition of the asset, so we're recording at historical cost, where the accountant in fixed asset is doing the calculations about the useful life, the depreciation method, and providing the general ledger accountant the adjusting entries for assets depreciation anytime the company does it, right? So our general discussion is always anytime a company produces a financial statement, and we're talking about GAAP here, right? Anytime they produce a financial statement, they have to perform adjusting entries that bring a lot of things up to date. And one of the accounts is the fixed asset account, right? So we need to then reconcile the fixed asset ledger balance to the general ledger balance, right? To make sure that support for the fixed assets, for the balance in the general ledger, we have support in the fixed assets sub ledger. There are risks again with these types of purchases, right? We have to make sure that they're authorized. We have to make sure we don't have the same people authorizing them as placing the order as accepting them, right? What we often sometimes see in small businesses, this would be example of a lack of segregation of duties. You know, we're going to have a higher level uh, administrator authorize to purchase a boat. And I'm using this example because it actually comes from some of the text we use in our accounting courses. But we can't have the CEO um, authorizing the boat, buying the boat, and then taking the boat home. Okay, that is an obvious risk. That's an obvious misappropriation, right? And we could have things like, um, you know, the first thing we learn is no personal use on corporate financial statements because that would overstate the assets, right? And that's what we are concerned about. Same thing regarding, you know, there's other things that they allude to in the text, like, you know, giving kickbacks and stuff like that. This is all the kind of things that you'll actually learn more about in auditing. So let's dig into AP a little bit more. As I said, AP is often one of the subsidiary ledgers that accountants start in. Um, that you can progress to a supervisory level or a management level. This is an important process, right? And I think we did a good job of kind of initially going through, okay, here's how purchase orders, purchase requisitions, purchase orders, receiving works. Now we're in the invoice process, the accounts payable unit. We get the invoice. We have to match all this, whether it all comes together, right? When the order is received, we might have the shipping notice, we might have the invoice presented, and then the person on the dock has pulled the copy of the purchase order, and then everything gets sent to AP. Or we send the receipt for the purchase, receipt for the order to AP, and they go through the process of matching, right? We need a three-way match. We need to know that it was an authorized order and that it came in and that the bill or invoice reconciles with the original purchasing. So sometimes we'll find discrepancies. So we have to negotiate with the vendor or we have to get an adjusted invoice, right? Because something came in damaged. So that coordination process has to take place. When we are ready to pay, often in that process, the invoices will be, when we're ready to pay, the invoices are often sitting in accounts payable. The companies usually have a regular date of when they pay their accounts payable. It could be weekly, it could be monthly. We know that the intricacies of management around accounts payable have to do with, do we want to take discounts? Can we take the discounts? Do we have funds to pay these, managing the cash outflows that go with this, right? So we're looking at that. It gets approval to be paid, and then they're paid. Typically, companies still use checks, right? For years, we've been talking about checks will go away. In fact, I was controller for a company that was developing those kind of processes. It still is, and some of them have taken effect. So we do know about EFTs, but not every company is sending funds via electronic funds transfer. And one of the reasons around that is really documentation. Okay. Now the blockchain has changed some of that. So when we send payments, there is now some information related to the payments, but that's usually a lot of what the problem is. When a payment hits a company's bank account, they may not have enough information to match it to the customer. So this is why we're still seeing a lot of checks, right? So when we record the purchase, right? We're debiting maybe a fixed asset account, an inventory account, an expense account. We're crediting accounts payable. Once we pay, we're debiting accounts payable, right? And we're crediting cash, okay? Which means we're eliminating the liability and reducing cash. That is all recorded in the ledgers, the general ledger. We often then go back during that month and look at the bank statement and reconcile the bank statement. And what we're interested in there is have all of our checks, have all of our payments to vendors cleared. Have they been processed by the bank? So, there's a step you might want to remember back, right? What kind of checks have not been cashed by the vendors yet, right? So we need to consider that in our reconciliation. The other might be, did something happen on the vendor side that our check was not recorded or not accepted? It wasn't charged to our account. It wasn't reconciled to our credit account. So these are all kind of steps in the process. And as I said, the last one is really to make sure that the accounts payable ledger reconciles with the general ledger. And that's our control. So as we know, there are risks associated in AP. So there are disbursement risks, right? Once again, it's all about the segregation of duties. You do not, in the end, want somebody who has a responsibility for entering the AP and paying the AP and reconciling the bank accounts. All right. There are opportunities in here to cover, right, inappropriate activities. The other thing is, we always talk about the responsibility of CPAs. CPAs are not responsible for detecting fraud. CPAs are not responsible for detecting fraud if something was never recorded. So one of the things you'll hear in the auditing is the hardest thing to detect is something that was never recorded, right? So this is an important thing in terms of the matching, right? What we're going to see in our data is this concept in our data analysis is this concept of duplicate payments or suspicious vendors, right? Somebody's paying a friend or a relative, right? This is why segregation of duties is so important. And our systems can control that, our people can control that. The last thing we talk about, right? Unusually large payments is something we want to keep an eye out for. And um, are we taking advantage of the discounts? This is so important. This is what AP managers are paid for, right? Because usually, not going into this very deeply, but usually managing cash flow is a part of AP. Taking advantage of discounts is a part of AP. This idea that, you know, the discount, a 2% to pay in 10 days, has uh, an annual savings effect, right? And to forego that, it could be an opportunity loss for the company. So that's something we often talk about in our finance courses. Um, and we can actually calculate what it's costing a company not to take discounts. So these are some of the key points in the accounts payable process. It it's significant the role that our automated systems play in this, but I think the key I want you to remember is automated systems are not the ones to approve, right? Purchasing. Okay. We need people to do that. We need people with good judgment and we need people who are not compromised. So, and who take saving the company money or keeping its relationships good with its vendors and are not known. We used to have, and keeping the company's credit score good, right? We still track that. And a company, uh, trade accounts facilitate business. They make it happen faster. And if a company gets a reputation for not paying on time or having difficulty paying, and the AP manager isn't attending to that, that's going to have a problem, reputational risk for the organization. So, see you next time when we'll talk about the mirror side of AP, which is AR.